Welcome to breaking news, to trading moves. Welcome to the debate. When an architect designs a reinforced concrete pillar, the math tells them exactly when it will break. It endures a specific, known amount of stress before fracturing.
Right, it's binary. It's absolute.
Exactly. But in financial markets, we try to manufacture that same structural certainty using a single, seductive metric, which is the risk-reward ratio. We're taught that if we risk 1 unit of capital to make 3 units, we build a shield against the chaos of the market. But what if the math we rely on to protect us is, the exact thing draining our accounts?
We naturally crave that structural certainty. It feels like an equation for absolute safety. We like our charts categorized neatly into defined risk and oversized reward.
Yeah, and the tension we are exploring today revolves around the mathematical foundation of those trading setups. I take the position that establishing a strong risk-reward ratio, often called an R multiple, is a necessary protective starting point for any strategy. It ensures your potential upside aggressively outpaces your downside.
And I take the opposing view. Relying on risk-reward ratios in isolation is a mathematical trap. Without prioritizing setup probability and statistical expectancy first, a high ratio is an illusion. In fact, mechanically forcing those ratios often leads directly to negative expectancy.
Let me elaborate on why I view the strict risk-reward ratio as the premier tool for survival. When a retail trader approaches a chart, they are immediately at a disadvantage. Price action is chaotic, right?
Oh, definitely. You're dealing with high-frequency algorithms, institutional order flow,
macroeconomic shocks, you name it. Because we cannot control the chaos, we have to build a structural margin of error into our process. By filtering strictly for setups that offer a 3-to-1 or 4-to-1 return, 3R or 4R, we establish a rigorous baseline.
But does that actually protect you in practice?
It actively prevents us from taking careless, impulsive risks where the penalty outweighs the prize. Think about the basic math. If you take a trade where you risk 2 units of capital to make half a unit, 1 single loss erases 4 consecutive wins.
Sure, the math on that specific inverted model is terrible.
Right, because that model requires a win rate that borders on perfection, which is psychologically and mathematically impossible to sustain over a career. Demanding a multiple on your return protects the trader from the inevitability of consecutive losses. It's an operational heuristic that just, keeps you in the game.
I understand the psychological comfort of that structural defense. I really do. But judging a setup by the size of the target alone remains a flawed methodology.
How so?
Because it ignores the mechanics of how price actually moves. We have clear mathematical proof demonstrating why. A 5-to-1 reward-to-risk ratio sounds vastly superior to a 1.5-to-1 ratio on paper, right?
Well, yeah, it looks like a much stronger defense.
However, if that 5R trade only works 15% of the time, while the 1.5R trade works 60% of the time, the visually less impressive setup is actually far more profitable. Risk-reward is an incomplete equation.
Because it gives you the size of the payout while blinding you to the likelihood?
Exactly. You're entirely focused on the geometry of the trade, but you're ignoring the physics required to reach that target.
I see why you lean so heavily into the probability side, but let me give you a different perspective. Doesn't demanding a strict ratio at least force a trader to define their risk clearly before they ever execute the order? Human emotion is the trader's worst enemy.
That's true. Fear and greed dictate everything.
Right. So if I know I need a minimum of a 3R return to justify my capital exposure, I am forced to identify exactly where my thesis is invalidated. I place my stop loss there, and I leave it alone. Aiming for a strict chart setup instills operational discipline.
In theory, maybe.
It forces a trader to sit on their hands and wait for the market to present an asymmetric opportunity, rather than, jumping out of a trade at a 0.5R profit just because they feel fearful. It's a rule that prevents behavioral meltdown.
I'm sorry, but I just don't buy that. Let me tell you why. Focusing purely on the ratio causes traders to force unrealistic targets onto the market. They try to make the chart display a 3R return just to satisfy a spreadsheet.
You think they're actively damaging their own performance for the math?
They absolutely are. Let's talk about the actual mechanics of a trade. A trader identifies a logical entry on an index. Market structure dictates a natural resistance level where taking profit makes sense, right?
Sure, a structural supply zone.
Let's say that natural resistance offers a 1.8R return, but the trader has a rigid rule demanding 3R. To achieve that arbitrary number, they must do one of two things. First, they might move their stop-loss tighter.
Which puts their stop directly into the market noise.
Exactly, into the bid-ask spread volatility. Even worse, they often place it exactly where institutional algorithms are programmed to sweep for liquidity. You aren't protecting your capital, you're literally offering it up as liquidity to market makers.
But a disciplined trader isn't just blindly tightening stops into liquidity pools. They are waiting for the market structure itself to organically offer that 3R spacing before they even consider the entry.
The reality is that the market rarely offers organic, high-probability setups with oversized multiples. Which brings me to the second thing a trader does to force the ratio. They push their profit target far beyond the natural resistance level.
Hoping the price just breaks through?
Yes, but resistance isn't just a line on a chart. It's a physical wall of sell limit orders. Asking price to blast through that wall, absorb all that opposing liquidity, and continue into thin air just because your rulebook says you need 3R, that's magical thinking.
I mean, that's a fair point about order flow.
A realistic 1.8R trade backed by structural logic is far superior to a forced 4R trade. When you reject trades simply because the ratio isn't high enough, you filter out your most reliable setups. You trade high-probability execution for a low-probability lottery ticket.
That is a compelling argument regarding the physical order book, though I would frame the broader concept differently. It comes down to the difference between treating a trade like a single coin flip versus owning the casino.
Okay, explain what you mean by that.
Well, a trader can make the absolute right decision based on market structure. They can identify the order blocks, read the liquidity perfectly, execute flawlessly, and still lose that specific trade due to a set-in-use event or an unpredictable algorithmic sweep.
Right, unavoidable market noise.
Conversely, they can make a terrible impulsive trade and win purely by luck. The risk-reward ratio ensures that when you do catch that winning outcome, especially in a trending market, you get paid enough to cover those random, unavoidable losses that the market hands you. The heuristic guarantees survival across a series of coin flips.
Owning the casino is exactly the right analogy, but you were drawing the wrong conclusion from it.
How so?
The casino does not rely on outsized 5-to-1 payouts to stay in business. In fact, if you look at roulette or blackjack, the payouts are often 1-to-1 or 3-to-2. The casino relies on a slight proven probability edge over thousands of events.
That's true. The house edge is mathematically fixed.
This is why the question to ask before clicking the buy button is never, how much can I make if this trade works? The question must always be, what happens if I take this exact trade 100 times? Expectancy is the only way to prove a system has a positive edge, and expectancy mathematically penalizes those highly aggressive targets.
If we actually look at the math under the hood, how does expectancy challenge the safety of a high-risk reward profile? Because mathematically, larger winners should offset the lower win rate.
Let's run the numbers. Expectancy combines your average win, your average loss, and your win rate. Imagine 100 trades. In scenario A, you demand your strict 5R ratio.
Okay.
Because your target is placed beyond multiple nodes of natural resistance, requiring the market to cross immense opposing order flow. Your win rate drops to 15%. Over 100 trades, you win 15 times. Assuming you risk 100 units per trade, you generate 7,500 units.
But the losses pile up.
Right. You lose 85 times, losing 8,500 units. Your strict, high-ratio strategy has a negative expectancy. You bled 1,000 units of capital precisely because you demanded an outsized payout.
And how does the math hold up in the alternate scenario?
In scenario B, you take the visually less impressive 1.5R setup. Because the target is logically placed before the major resistance wall, your win rate is 60%. Over 100 trades, you win 60 times, generating 9,000 units.
And the losses?
You lose 40 times, losing 4,000 units. So you profit 5,000 units. A high-reward target with a very low win rate continually loses money, while smaller winners with stronger probability build equity steadily. The mechanics of probability absolutely crush the theoretical appeal of the massive ratio.
I have to push back strongly there regarding the practical application of that math. If expectancy requires precisely knowing your win rate, how can an independent retail trader accurately determine this probability before risking real capital?
It takes work.
Let's talk about retail realities. Traders notoriously overestimate how frequently their setups work. Memory is highly selective. We remember the times our 4R target was hit perfectly, and we conveniently forget the 12 times price retraced entirely just before reaching it.
Which is exactly why relying on feeling is dangerous.
Exactly. But requiring perfect statistical expectancy is a quant's game. Retail traders do not have the algorithmic tools to calculate a 60% versus a 58% win rate in real time. The 3R ratio is a necessary heuristic precisely because we cannot perfectly calculate expectancy. If we are operating in the dark, a strict risk-reward rule prevents ruin.
Probability is not a feeling, and you do not need a supercomputer to track it. It comes exclusively from data, repetition, and review. You don't guess your win rate, you calculate it. Manually.
By hand every time?
Yes, it requires rigorous data collection. You need to know exactly how a specific setup has behaved before you risk real capital on it. Relying on a heuristic just because you were too lazy to do the backtesting is a recipe for a blown account.
Then walk me through the mechanics of that. What specific variables must a retail trader track to calculate this effectively? Because just writing down win or loss in a spreadsheet seems completely insufficient to build the kind of robust statistical edge you're describing.
Oh, it is absolutely insufficient. Tracking probability means logging an extensive set of mechanical variables. You track the entry trigger and the exact exit. You track the broader market conditions. Is the market in a directional trend or trapped in a volatile range?
Right, the macro environment.
And you track the time of day. Let me explain why that matters mechanically. If you take a breakout trade during the morning session, institutional algorithms are highly active, providing the underlying liquidity to push your trade to the target.
Because the volume is there to support the move.
Precisely. Now, if you take that exact same breakout pattern at 2 o'clock in the afternoon, the volume is dormant. The pattern looks identical, but the mechanics are totally different, meaning the afternoon trade will likely fail.
Wow. So the time filters the probability.
Yes. You track volume behavior, and crucially, whether your logical target was actually reached or if the trade reversed prematurely. Over time, this exhaustive data collection proves whether the setup has a genuine edge or if it only looks good in hindsight.
That level of detailed journaling is demanding, but I recognize its necessity. Rigorous backtesting strips away the illusion of the perfect chart. It's very easy for someone to post a screenshot on social media showing a 10R theoretical return after the market has already moved.
Too easy.
It is vastly harder to execute a 1.5R return consistently, day after day, in live conditions while battling your own psychology. The evidence found in a detailed journal anchors the trader to reality.
Precisely. Trading is not about being right once. One winning trade proves very little about your skill, just as one losing trade proves very little about your strategy. The edge appears only across a series of events.
Sample sizes over single events.
Yes. As you noted earlier, you can make the right decision and lose, or make a bad trade and win by sheer luck. The goal is to build a process that produces positive results over hundreds of repetitions, ignoring the outcome of any single execution.
Which means evaluating trades in sample sizes rather than single outcomes transforms a trader's entire psychological framework. If you take a loss on a highly probable setup, you do not abandon the strategy. You don't revenge trade.
No, you just accept it.
You simply record it as one of the 40 inevitable losses out of 100, knowing the 60 wins will ultimately outpace them over the quarter. But I maintain that during those 40 losses, the risk-reward ratio is what prevents you from bleeding out entirely before the probabilities have time to play out.
Evaluating in sample sizes is vital, yes.
And that is exactly why demanding a perfect risk-reward ratio on every single trade forces traders into poor execution. They judge themselves by the single outcome of the trade they're currently in, staring at the floating profit, rather than the aggregate outcome of the next 100 trades.
They get tunnel vision. Before taking a trade, do not only ask what the reward is, ask how often this exact setup works under these specific volume conditions. Ask whether the target aligns with realistic market structure, or if you're hoping price magically breaks a major order block.
So, if we step back and look at the whole picture you're painting, it sounds like you're saying the concrete pillar isn't just about the rigid dimensions of the materials, the ratio. It is deeply dependent on the physics of the environment it sits in, the probability.
That's a perfect way to summarize it. I maintain that establishing a logical stop and a realistic reward remains a vital part of evaluating any trade. A trader must protect their capital by ensuring their winners are mathematically capable of absorbing their losers. The concept of risking a small amount to make a larger amount is a necessary structural guardrail.
If executed within logic, yes.
It keeps human emotion in check, provided the trader does not blindly chase perfect, unrealistic ratios at the expense of market logic.
And my perspective is that risk-reward is just a number on a chart until it is directly paired with probability. An outsized, theoretical target is completely useless if the price physically cannot reach it due to order flow. Consistency only comes from repeatable setups with a proven, journaled edge.
Synthesis of both metrics. A high probability of a minuscule return cannot overcome the cost of the spread and commissions, just as an outsized return with a near zero probability leads to a slow depletion of capital.
Right.
Returning to our structural metaphor, the reinforced concrete pillar needs both the correct materials, the probability edge, and the correct mathematical dimensions, the risk-reward ratio, to hold the weight of the building against the chaos of the environment.
If you lack either component, the structure ultimately fails under pressure. The math simply will not support it.
We will conclude our exchange here without declaring one metric definitively superior to the other, as both must function together to create a robust methodology. The question remains for you to answer in your own practice. Open up your trading journals. Are you taking trades based on a proven statistical probability backed by market mechanics, or are you merely chasing attractive ratios on a screen?